This video provides the introduction to our project 3, which is going to be loan amortization. Before I jump into loan amortization, I just want to quickly get you guys thinking a little bit about loans and what loans are. So project 1 and 2 dealt with equity, which is going to be stock. Another important thing for companies is debt. So debt is going to be exactly what it sounds like. So they're going to be borrowing money from somebody else rather than buying a share in the company. With project 3, we're going to be talking about loan amortization, particularly as it pertains to personal finance. So here we're not talking as much about corporate loans or corporate bonds. That's actually going to be our project 4. Here today we're going to be talking about personal loans, which means loans that are more common for individuals. So for example, the type of loans that we'll be talking about would be loans similar to if I went and took out a loan to buy a car or if I had a loan to buy a house. So what do these loans look like? So basically it's going to be, I'm an individual, I want to buy a car or a house and I cannot pay for it in cash. What will happen is I will go to a bank most commonly and from there apply for a loan, get a loan. And what happens is the bank is going to basically give me the money. In return, I'll pay back that debt that I owe them, and they will also charge me interest. So why will they charge me interest? Because that's the way they're going to make money. So the interest is basically the extra money that the bank is going to make from giving me the loan. When we talk about loan amortization, this is typically going to be paying attention to the fact that when I have the loan, some of my payments are going to go to paying back that debt. Some are going to go to paying back that interest. And an amortization schedule is going to show kind of the breakdown of that relationship for the life of your loan. That actually is going to be our goal of project 3. So project 3, you're going to be making amortization schedules for 2 different types of loans. And we'll talk about that a little bit in this video. And then of course, I'll get into more detail pertaining to it for your guys' project video for project 3. All right, so with an amortized loan, you're going to have scheduled periodic payments, and anytime I make a payment, so if I have a loan, let's say I have a monthly payment of $100, each period, part of that $100 is going to go towards paying principal. Principal is just a fancy way of saying the money I owe the bank, so the debt. So the bank gave me a loan for $100,000. My principal part of my payment is going back to paying that $100,000 they gave me. Is the bank only going to want the $100,000 back? No, they're going to also want their interest portion. So every month, part of my $100 payment is going to go towards principal, part of it's going to go towards interest. So interest is again going to be the money that is the bank's money. So the money that they're making as a profit for providing me this loan. So this split kind of payment, so every payment I make, part goes towards principal, part goes towards interest, is different than interest-only payment features, which we'll talk about a bit more of that type of structure next class when we're talking about corporate loans. So amortized loans, we're talking about you make a payment every period, part of that payment is going to go towards principal or the debt that you owe, part of it's going to go towards interest, which is the money that goes to the bank for profit. The reason that amortized loans are so common for personal finance loans, so loans that individuals are going to take out like car and home loans, is because you know what to expect. So you're going to have these set payments every period. The payments will not change unless your interest rate changes, which we'll talk about here in a second. So you know what to expect, and it gives you a very clear picture of kind of what's going to happen, and it hopefully lets the user or the individual avoid payment shock. So that is going to be kind of why you'll see these kind of amortization schedules and this type of structure very common in personal finance. When we have amortized loans, you'll have a fully amortizing loan. So again, if the borrower makes the payment, so if you took out a loan and you make all of your payments on time, by the end of the loan, how much should you owe the bank? So you should owe the bank nothing. So if I make all my payments on time, then I should have, by the end of this, fully paid off my loan. The nice thing about project 3 is going to be that the project checks itself. So for both of your banks, the last number you should get is 0. So your ending balance at the end of this whole loan should be 0. Sometimes Excel will have rounding errors and give you maybe 0.0001, but essentially 0 should be your last number in your amortization table. The big difference between the two banks that you'll be looking at is a fixed rate loan versus an adjustable rate loan. So why do some individuals prefer fixed rate versus adjustable rate? Or why might individuals prefer adjustable rate over fixed rate? I would say that the benefits of fixed rate is a fixed rate loan means that my interest rate is 3%, and that interest rate will be the annual interest rate charged to my loan over the full life of the loan. So if I make all my payments, I know my payments will never change because my interest rate's never going to change. And so you get it fixed in at the very beginning. An adjustable rate loan means that I have a certain interest rate, but depending on what that interest rate is pegged to, let's say it's pegged to inflation or the overall LIBOR or the Fed rate. So if that rate goes up, then my interest rate could also go up with it. The benefit though is if the market interest rates go down, then my interest rate could also go down with it. So which one is better? That depends on the individual. Typically, most people like to have the risk averse, and so you want to know what your interest rates are and you want them locked in, no surprises. So in that case, a fixed rate loan would be preferred. Also, currently we're in a pretty low interest rate environment, so it's cheap to borrow money. Oftentimes, if you're in a low interest rate environment, you want to lock in that low interest rate for the 30 years or whatever the life of your loan is. So oftentimes you'll go for a fixed rate. However, if you're in a high interest rate environment where interest rates are much higher than they have been historically, maybe you would prefer an adjustable rate and hope that interest rates drop in the future. Banks in a low interest rate environment obviously have adjustable rates preference maybe a little bit because they want you to do an adjustable rate, lock it in, or have the adjustable rate instead of being locked in for 30 years. If interest rates in the market go up, they might be able to charge you more. So sometimes you will find in the market that a fixed rate loan in a low interest rate environment might be slightly higher than the starting adjustable rate loan. The starting adjustable rate might be a little bit lower to try to entice people to take it, but you always have the risk that if interest rates do go up, your loan could increase with it. With our project, we're gonna have one loan that is a fixed rate for the whole loan. That's a pretty simple amortization schedule because nothing really changes when it comes to your payments. With an adjustable rate loan, if I got an adjustable rate loan today, I don't know if interest rates will change and I don't know when they will change. So in the real world, you could maybe say, I think this will happen, but you don't know what will actually happen. So with our example for the adjustable rate loan, I'm gonna tell you guys that let's assume interest rates do this in this many years, and we're gonna incorporate that change into our model. So again, in the real world, when you did it, you wouldn't actually know if that change took place. But for our purposes, we're going to just say, hey, let's assume this is going to happen, and we'll just have one interest rate change in our model. When we are doing our amortization schedules, again, I said with an amortized loan, you're going to have part of the payment's going to go towards principal, part of it's going to go towards interest. So as an individual, I kind of want to see what my payments are going to be. Again, if it's a fixed rate loan for the entire time, my payment will be the $100 every year or month, whatever the frequency of the payments are. Typically with personal loans, they'll be monthly. So we'll have those payments, and then each period I want to know how much of that payment goes towards interest, how much goes towards principal. I'll repeat this again when we get to our project YouTube, but please make sure that when you're setting up your amortization table, you're using these formulas currently on the slide. So I want to see you guys using these formulas. Please do not use any other functions that might be available or pre-made templates. So as I said at the start of this class, everything you're building should be built from scratch in Excel. This is probably the easiest one to maybe not have that apply, but I want you guys using this formula and seeing what happens with the numbers, making sure you're able to incorporate these formulas into Excel accurately. So please use the formulas that I talk about in class, the function I will talk about in class, and then no outside kind of resources. So everything, again, I just want to reiterate, should be from scratch. So for this example, I'm talking about an annual or a loan. So basically, I took out a loan for $5,000. I got that $5,000, turned around and paid it off. Now I need to know what my payments are going to look like. With this loan, I'm assuming annual payments. For your guys' project, you're going to be doing monthly payments. So that will be one big difference between this example and what you all are doing in class. I'm also only going to show you guys the PowerPoint slides of this. I'm not going to do it in Excel because you guys do have that as your primary factor for your project. However, I did put some help for this project on YouTube in a separate video pertaining to doing a quick amortization schedule in Excel. That's probably the most help you'll see for a project throughout this class. So I strongly encourage you guys to check that out on our YouTube channel when you are doing this project or before you do the project. All right, so what is this gonna look like? I took out a $5,000 loan, annual payments, so that lets me know I'm making one payment per year. I'm getting charged a 9% interest rates, and I have 5 years until maturity. So if it's an annual loan, it means I'm making 5 total payments before my loan is fully paid off. As the borrower, I will be making payments of $1,285. In this case, I gave you guys the number to start with. In the second part of class, we're going to talk about time value of money functions. That's going to be how you will get that payment number. So if you think back to your introductory to finance class, if I want to find out what my payment is based on a present value of $5,000 that I'm taking out the loan for, I have my rate of 9%. My N, or number of periods, is going to be 5 years. I solve for PMT, and my PMT comes out, or payment comes out, to be $1,285. So those steps are going to be what gave me that $1,285. How to do these time value money functions in Excel is going to be what our Excel skill portion of this video will be next. So definitely watch that one next. All right, now let's talk about the formulas that we'll use. So I have my payment. I make a payment of $1,285 every period. How much goes towards interest? How much goes towards principal? So my interest paid, and then you have the little n, means every period. In this case, I'm making annual payments, so I have every year. Each period, to get the interest paid, is going to be my beginning balance. So my beginning balance for that year. So not for the loan. The loan amount is $5,000, but my beginning balance is basically like, how much do I still owe? What's my tab still each period? So we have our beginning balance, that period, that's why there's that little n, times R. So what do we think R stands for? That's going to be our interest rate. So here our annual interest rate is 9%. So we have the 5,000 times 0.09. When you're doing it in Excel, again, you should have it as a percentage format. So my interest paid for year 1 is $450. So if $450 went to interest, then the rest must have gone to principal. So of the $1,285, $450 went towards interest, again, the money that goes directly in the bank's pocket. The remaining amount is going to be the principal paid. Again, what does that principal paid mean? That's me paying down my tab to the bank. So I owe them $5,000. That's how much my debt is. I also have to pay them interest, the money that they make off my loan. But how much is actually paying down my debt? That's the principal paid portion. So of my $1,285, $835 of it is going towards paying down my debt. So how much total do I still owe the bank of that $5,000 at the end of the first year? That will be my ending balance of the loan. So if I take my beginning balance, the full $5,000, minus the principal part, because again, the principal is the only part that's paying down my tab that I owe the bank. The remaining $4,164 is going to be how much I then owe starting at year 2. So that end of year 1 balance is going to be my start of year 2 balance. All right, so this is what the amortization schedule is going to look like. Again, the first thing you're going to want is the number of periods. In this case, I'm doing annual payments, so I'll have years. When you guys are doing your project, you'll have monthly payments. So instead of years, you'll want number of months going down. Our beginning balance will then be the next column, total payments, interest, principal, ending balance. So this kind of labels across the top will basically be identical for you guys for your project for both Bank A and Bank B loans. So for both loans, you're going to want that same kind of top line. The only difference will be instead of years, it'll be months or number of periods, whatever you want to label it. My beginning balance is the $5,000 I took out. So that's going to reference to the loan amount. So my $5,000 is my loan amount. The total payment, again, for a fixed rate loan, the total payment is going to be the same amount every period. So I solve for that total payment with the PMT function. My payment will be the $1,285, fixed interest rate loan, same every period. I will talk about adjustable rate in your guys' project sheet or project YouTube. For the interest paid is going to be that formula we talked about on the last slide. So it will be our beginning balance, so whatever number is in this column, times, in this case, it's annual payments, so our annual interest rate of 0.09. If you guys are doing this monthly, then everything will have to be changed into monthly terms. So you'll have, instead of years, it'll be months. Instead of an annual interest rate of 9%, we'll use a monthly interest rate. But again, we'll talk about kind of the changes that will happen with annual versus monthly in our next video. So for our interest paid, again, I got this number, the beginning balance times the annual interest rate of 9%. And then the payment minus interest rate gave me my principal paid. How did I get the ending balance? Again, that's beginning balance, so whatever's in this column, minus, is it interest or principal? So which one? Or is it total payment? So it is our principal paid, because again, the principal paid is the only thing that's gonna drop down how much I owe the bank. So the interest is, again, the money the bank is getting. So if I take my beginning balance minus principal paid, that's my ending balance for year one. After I have my first year set up, I usually go and set up my second year as well, or my second month, so second line. Once I have my second line set up, I'll be then able to carry that down through my model. So where did this beginning balance come from for year two? That's gonna be my ending balance for year one. Payments are again the same. How did I get the interest rate? So notice it's a different number from the one above. That's because I'm taking the year two beginning balance, the $4,164, times the annual interest rate. So that will get me my interest paid. Principal will be the same formula, so total payment minus interest paid gives me principal. As I get further in my loan, more of my payment's gonna go towards principal, less is going towards interest. And my ending balance now at end of year two is gonna be the $3,200. So how much I actually owe the bank still from that initial $5,000 loan is now $3,253 and change. So that kind of setup is gonna carry through all the way down to year five. When we get down to year five, the one thing I want to just touch on is this ending balance. If you remember, I said that the way these loans are structured, if I make all of my payments, by the end of my loan, I should have a balance of zero. So if you make all your payments on time, then you should have a balance of zero by the end. So this is where I'm saying your guys' project will check itself. Your ending balance for your last period should be zero. Again, sometimes Excel will round it a little weird throughout, but it should come out as essentially 0.00. Sometimes it'll make it red, which assumes it's a negative, but it's just rounding with Excel. So it should be approximately zero though for you guys. The other thing I want to touch on is this gives a bunch of information to the user. It lets me know, so I know my payments won't change, but it gives me an idea of if I'm borrowing $5,000 from the bank, how much total am I going to be paying over time? So kind of ignoring time value of money, if I just take all my payments and add them together, so this we could use the sum function, so equal SUM, and then select all of these cells. That will give me my total payments of $6,427. So what this means, all my payments together means in total I'll be giving the bank $6,427 for the $5,000 they gave me today. So the difference, so they gave me $5,000, that's my debt, I'm paying them back. The extra $1,427 is going to be the interest that they're making from my loan, so the money that they're making from my loan. How I got these other numbers is, again, just adding together everything in that column. You do not want to go manually and click this plus this plus this. So again, use the sum function just like you guys use the average function, where you'll do equal sign, SUM, and then select all the cells you want to add together. Assuming you set it up the same way I did, you'll have everything in a column, so you can just select the numbers in that column and it will add them up for you. When we are doing amortization schedule, make sure that your payments are displayed as a positive number. So again, we'll be doing the payment function to solve for this. Just make sure that when you do have the payment number, it's not showing up as a negative. If it is, you will want to times it by -1 to turn it positive. The way the formulas work is it assumes that everything is presented as a positive number for the amortization schedule, even though in finance, we typically will talk about money in, money out. So I'm making a payment really that does go as a negative number for me as a user, like I'm paying this much money. But with the way the formulas work, you want it presented in the table as a positive number. So just make sure it's displayed as a positive number and used throughout all of the formulas as a positive number. That money in, money out aspect, again, we'll talk about once we go through those time value of money examples and time value of money problems. Again, there's multiple ways to complete an amortization schedule, but for this project to get full credit, I want you guys using the formulas I just showed you in the last couple of slides and the method I just talked about in the last couple of slides. So please do not use other Excel formulas or any other type of templates when completing this. It should all be from scratch. Also, don't forget to color format. If you don't remember the color formatting, either watch the formatting Excel part of project 2, or there is a color formatting example in your YouTube videos as well. A little bit about where this shows up in the real world. So I said that amortization schedules will typically take place for personal loans. So you'll have mortgages or car loans. This one is going to be talking about, or this project will be talking about house loans. My couple slides here are just saying you're probably going to buy a house at some point in your life. When you do, just be aware of the market. So as many of you are aware, there was the Great Recession, and during that time, part of the contributing factor was going to be what was happening with home prices and home loans. So you had major changes in what was happening with mortgages and rates and loans that were being given. So it also impacted home prices. So just be aware of kind of your market. If we think about Nashville is growing quite a bit. So how is that going to impact my home price? What's happening with interest rates right now? So do your homework. My other advice to you would be don't just go to one bank. You're going to be spending it's probably gonna be one of the biggest purchases of your life. So make sure that you do your homework, shop around, and get a good interest rate prior to doing a house. You don't just wanna go only to the bank where you have your checking or savings account and use them as a loan. Make sure you get some other comparable interest rates and get the best deal you can, because that little bit of difference in interest rate will make a lot of difference when it comes to your total payments. That I will say is one nice thing about doing these models in Excel. If you guys change your interest rate from 5% to 6%, it's very easy to see how much that impacts your total interest rate that you're going to be paying, or your total interest that you'll be paying. So again, use these models or create these models for class, but they could also come in handy in actual life. So personal finance is a very important part of our field. When you are buying a house, you don't only need to think about the loan that you're going to be taking out. Typically you're going to need a down payment as well. As a first-time home buyer, they will often let you put less than the 20% down. So anywhere from 5 to 20% is pretty normal. However, if you do less than 20% down, there is a good chance you'll be charged PMI, so that's private mortgage insurance. That's going to basically be you paying for insurance to protect the bank. So that is basically saying you're not putting enough money into the house. They want you to have a down payment so you kind of don't trash the house, or you want to keep it nice. If you can't make your payments, then they could kind of take it over and resell it to give the money to the bank. So they want you to kind of have a stake in this. And so the PMI, though, is going to be insurance because you weren't able to put enough money down. So it's going to cover that amount for if you don't pay for the bank. So PMI is a double hit against you because you're buying insurance and it doesn't even protect you, it protects the bank. So just be aware of that as well. Also, closing costs can add up quite a bit. So just be aware that you'll have to have things like potentially fees for credit reports and filing fees and inspections for the house. So when you're going into this in a real life situation, just be aware of all the extra costs that do come into play. All right, so that is it for just the information about our project. I now will have the second video, so click next on the one that is going to cover our Excel skill, which for this project is going to be focusing on time value of money. For your guys' project, this project you'll be using just the payment function pertaining to time value of money. However, in future projects, you will need other financial functions, so like solving for the rate or for the number of periods. So I'm going to talk through all of those in that video, but that will be information that you'll need in future projects as well. So don't just only pay attention to the payment part, pay attention to kind of all of the examples.